Welcome to episode number 5 of our new series, Financial Analysis Techniques, Global Case Studies. Our topic today is the debt and gearing analysis. And the two largest global producers in the building material industry will be our case study today. Debt and gearing analysis is a way to analyze and manage debts and loan obligations. By analyze the level of debt obligations incurred by a company against several other accounts. For example, equity or assets in the company balance sheet, EBIT, earning before interest and tax or earning in the income statement, or operating cash flow in the cash flow statement. For further details, we asked Muhammad Al-Yamani and he stated that
debt analysis is the process of evaluating a company's level of debt and its ability to pay off that debt over time. This includes analyzing the company's financial statements to determine the amount of debt it has, the interest rate on that debt, and the company's ability to generate cash flow to cover the payments. Gearing analysis, also known as leverage analysis, is a similar process but focuses specifically on the company's level of financial leverage. This includes analyzing the company's debt-to-equity ratio, interest coverage ratio, and other metrics.
now let's start with some example ratios that based on the annual debt service. But take care, the annual debt payment is not the accumulated debt obligations that presented in the balance sheet. As you can see on the right is a summary of 3 financial statements with its financial notes. Our first ratio, as an example, is the DSCR, Debt Service Cover Ratio. The Debt Service Cover Ratio, or DSCR, is a measurement of a firm's available cash flow to pay current debt obligations. To calculate it, you need to divide the net operating income, or EBITDA, earning before interest, tax, depreciation, and amortization by total debt service. But take care that I will be divide the annual debt service payment, not the accumulated debts on the balance sheet. A good debt service coverage ratio could be at least 1.25. The DSCR that equal or greater than 1.25 means the company is in a good position to take on more debt in case of need. If the SCR equal 1, it will mean that the company is allocating almost all of its available income to paying off debt. And if it is less than 1, it will mean that the debt service is costing the company more than they are generating in income, which is a business failure indicator. The second ratio is the debt to income ratio, or DTI. You can calculate it by divide the total monthly debt payments by the total or gross monthly income. This is by dividing the annual debt payments by 12 months. The DTI, if it will equal 40 or to 49%, it will be acceptable. It will be acceptable. But take care about the unforeseen circumstances, as it could put your company in financial trouble.
The third ratio, debt to EBITDA ratio, is equal total debt service divided by EBITDA. It measures the business ability to cover its annual debts using earnings. The cash flow coverage ratio is equal cash from operating activity divided by the total debts. This time is the accumulated debts on the balance sheet. But I prefer to exclude the other current and non-current liabilities and provisions. It measures the company's ability to cover debts from its operating cash flows. The working capital to debt ratio is equal to the net working capital divided by total debts. It measures the company's ability to settle all of its debts using only its working capital. The long-term debt to non-current assets ratio is equal to the long-term debt divided by the non-current assets. It represents the percentage of the non-current assets that are financed with long-term debt. The debt-to-assets ratio is equal to total debts divided by total assets. It measures the company's ability to cover debts with its assets. The interest coverage ratio calculated by dividing the EBIT by finance cost. It is based on each case of business or industry, as some companies may use the net finance income minus expenses, and other may use the finance cost only. Finally, the debt-to-equity ratio D/E is equal total debt dividing by total equity. It's the company financial leverage and long-term solvency.
Now let us see an example that is one of the ACCA past exam questions, paper F7 of financial reporting. You can download the full questions and answer from this link.
The most important skill required by the ACCA is to interpret the analysis, not just calculating it. As you see, gearing ratio has increased significantly, as a result of increase in loan capital of $7 million, to finance a new business acquisition. See the new item of intangibles that could be goodwill of the new investment. Also, an increase in the finance interest from 5% to 8%, that affect the income statement finance cost and the interest cover. Finally, although the dramatic increase in the gearing ratio, and the consequent fall in interest cover, but the company still hope that its new investment will bring in future returns and show considerable improvement.
Another comprehensive example, but this time related to FPAC certificate, the Certified Corporate Financial Planning and Analysis Professional.
It's about the calculation of the DFL degree of financial leverage. It is calculated by dividing the percentage of change in EPS by the percentage change in EBIT. First, calculate the percentage of change in earnings per share, EPS, and earnings before interest and tax, EBIT. By dividing the new value of year 2021 by the old value of year 2020. Then minus 1. Finally divide the 2% to get the DFL ratio.
Also, I have included two examples of two global case studies in the building material industry. The first case is Saint-Gobain, and the second case is ArcelorMittal. I have calculated six issues analysis as an example for the last 3 years. Recent 3 years. You can click on each cell to know the formula of calculation, but take care about the following.
Each financial analyzer can amend or adjust the ratio formula calculation for better performance analysis. For example, can exclude some irrelevant items from the calculation. For example, I prefer to exclude the provision and tax liabilities when calculating the debt-to-equity ratio. Also, the appropriate ratio will vary depending on the industry the company operates in and its overall financial situation. Again, Our today's episode was just a quick overview of the gearing and debt analysis. I just wanted the episode to be 10 minutes as most of you requesting. See you next episode.